You've seen it, right? Those scrolling green and red numbers on the news? The S&P 500, the Dow Jones. They tick up, people are happy. They dip down, and suddenly everyone gets serious. But what does any of that actually mean? Well, in this explainer, we're going to pull back the curtain on the whole thing, breaking down the stock market piece by piece to see how it really truly works.
So here's our roadmap. We'll start with the absolute basics. What even is a stock? Then we'll look at where they come from and where they're traded. We'll meet the key players, follow a single trade from start to finish, and then zoom out to see why all this matters to everyone. And finally, we'll get into some of the really big controversies shaping the market today.
Okay, let's dive right in. Before we can get our heads around this massive global market, we've got to understand the fundamental unit, the single atom of this whole universe, one share of stock. So what is it? At its core, a stock is just a tiny, tiny piece of ownership in a company. Seriously, that's it. When you buy a share, you're not just buying a ticker symbol on a screen. You are buying a legitimate slice of that business. The whole point of the market is to connect companies that need cash to grow with investors who have that cash and are willing to provide it in exchange for a piece of the potential profits. And those profits can come back to you in two main ways: dividends, which are basically small cash payments from the company, or capital gains, which is when you sell the stock for more than you paid for it.
So beyond all the frantic trading, the market is really doing two incredibly important things for the economy. First, it's a massive engine for capital formation. It's how companies raise money for huge projects, building a new factory, funding groundbreaking research, without having to go deep into debt. Second, it's a giant system for resource allocation. You can think of a stock's price as a signal that efficiently funnels money toward companies that investors believe in and away from the ones they think are on the wrong track.
So how does this actually play out? I mean, stocks don't just pop into existence. They have a whole life cycle that unfolds across two very distinct but deeply connected arenas.
On one side, you've got the primary market. This is where brand new stocks are created and sold for the very first time, like during an initial public offering, or IPO. This is the moment the company actually gets the cash infusion. Then you've got the secondary market. This is what we all think of, the NYSE, the NASDAQ. It's where all the day-to-day trading of existing shares happens between investors. And here's the crucial link. The secondary market is what makes the primary market possible. Think about it. Why on earth would you buy a new stock directly from a company if you had no way to ever sell it to someone else later? The secondary market provides that essential ability to buy and sell, which we call liquidity.
And that IPO process? It's basically a company's big, fancy debutante ball. It is a highly structured, intense journey. The company partners up with an investment bank, files mountains of paperwork with regulators like the SEC, then they go on this marketing tour called a roadshow to get big investors hyped up. And only after all that do they finally set a price and the stock hits an exchange, beginning its life as a publicly traded company.
So who exactly is doing all this buying and selling? Well, the market is this incredibly complex ecosystem with a whole cast of characters, from regular folks like you and me to massive global powerhouses.
Investors really fall into two main camps. On one side, you've got retail investors. That's probably most of us, right? Everyday people investing for personal goals like retirement. But on the other side, you have the institutional investors. These are the pros: mutual funds, pension funds, huge investment banks. And the difference in scale here is just staggering. A retail investor might buy, say, 10 shares. An institution will trade in blocks of 10,000 shares or more, and that gives them enormous influence over where prices go.
In fact, they're often called the whales of the market. And it's a perfect description because when one of these massive entities decides to make a move, it can create waves that every other fish in the sea is going to feel.
And holding this all together, behind every single trade, there's this hidden infrastructure. You can think of it as the market's plumbing. Your broker is what gets you access to the pipes. Then you have market makers. These are specialists whose entire job is to always be ready to buy or sell, ensuring there's always someone on the other side of your trade. And finally, clearinghouses act as the ultimate guarantor, stepping into the middle of the trade to make sure the stock goes one way and the money goes the other, completely eliminating the risk that one side won't hold up their end of the bargain.
So, with all those players and all that plumbing in place, let's zoom right in on that one single moment. What actually happens in the milliseconds after you hit that buy button on your screen?
Well, first, you have to make a choice. A market order basically says, get me this stock right now at whatever the best price is. You're guaranteed to get your shares, but the price might slip a little from what you saw a second ago. A limit order, on the other hand, says, get me this stock only if you can get it at this specific price or better.
Here, you get certainty on the price, but you run the risk that your order never gets filled at all if the market moves away from your target. It's that classic trade-off. Do you want speed or do you want price?
Okay, so once your order is placed, it zips through this three-step process. First is execution. Your order gets matched with a seller. Then comes clearing, where all the details are double-checked and verified. And finally, settlement happens one business day later, when the ownership and the funds are officially transferred. Now, this whole process used to take 2 days, but it recently got sped up to just 1, which we call T+1. And that might sound like a tiny technical change, but it's a huge deal for regulators. Why? Because the shorter that time is between the trade and the final transfer, the less risk there is of something going catastrophically wrong and causing a domino effect.
Okay, so we've been deep in the weeds with the mechanics. But why should anyone who isn't a Wall Street trader care about any of this? Let's zoom way back out now and look at the big picture.
A stock's price is not just a random number flashing on a screen. It is an incredibly powerful signal. It represents the constantly updated collective judgment of millions and millions of people about a company's health and, way more importantly, its future. It's like a real-time global poll on corporate value.
Now, this idea leads to a very famous and very heavily debated theory called the efficient market hypothesis. In simple terms, it's the idea that you can't consistently beat the market. Why? Because all the known information, the good news, the bad news, the rumors, is supposedly already reflected or baked into the stock's current price. If it was easy to spot a bargain, someone would have already bought it, pushing the price right back up to where it should be.
So to take the market's temperature, we use indices. You've heard of them. The Dow Jones tracks 30 huge, established blue-chip companies. But the S&P 500 is generally seen as a much better snapshot of the U.S. economy. It tracks 500 of the largest companies, and it's weighted by their total market value. That means the bigger and more valuable the company, the more its stock movement influences the index. It just gives a much more comprehensive picture. Okay, for our last section, it's important to remember the market isn't some static, unchanging thing. It is constantly evolving. And today, technology has pushed it into some really complex and controversial territory.
Two of the biggest features of the modern market are high-frequency trading and dark pools. HFT uses supercomputers to make trades in millions of a second, trying to profit off of tiny, fleeting price differences. Dark pools, on the other hand, are basically private stock exchanges. And why do they exist? So those whales we talked about can trade enormous blocks of stock without tipping off the public market and causing a huge price swing. Now, defenders say both of these things make the market more efficient, but critics raise serious questions about fairness and whether the game is being rigged in favor of the big, technologically advanced players.
And all this technology brings us to a very pointed question, especially with all these commission-free trading apps out there. If you're not paying for the product, are you the product?
Well, the answer lies in a business model called payment for order flow. This is the engine that makes free trading possible. Here's how it works. When you hit buy, your broker doesn't just send your order to the NYSE. Instead, they sell your order to a massive trading firm, a market maker, who pays them for the right to handle your trade. And this creates a really obvious potential conflict of interest. Is your broker's number one priority getting you the absolute best possible price, or is it routing your trade to the firm that pays them the most?
And this idea of financial activity happening away from public view, it's not just about retail trades. It's a key feature of a much, much larger and more concerning area that regulators call the shadow banking system. We're talking about a massive $63 trillion ecosystem of non-bank firms operating largely outside of traditional oversight, and they often create huge risks that could threaten the entire financial system in a crisis.
Which leaves us with one final critical question. The stock market is, without a doubt, an incredible engine for growth and a powerful economic signal. But as it gets dominated by lightning-fast algorithms, private exchanges, and business models that are anything but transparent, we really have to keep asking ourselves, who does this evolution truly benefit?